You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest's senior options analyst and author of the Options Playbook. All right, well, we had a big earnings week last week. I think something like 36% of the S&P 500 index actually reported last week. But more importantly, we talked a lot about the quadruple witching day, if you will, where on Thursday of last week, where we had Google, Apple, Facebook, and Amazon all reporting on the same day, a Thursday after the close. Now, we talked a little bit about buying puts as protection, and a more interesting way, if you happen to own all of those stocks, how could I go about trying to buy some protection without buying protection on each individual stock? And we talked about doing put spreads, long put spreads in the QQQ, and also the potential of just buying puts outright. And the concept on buying puts for protection around earnings and buying put spreads for protection around earnings kind of makes sense in a frothy market. We had all-time highs in a lot of these underlyings, definitely highs since their March lows. So there's all those stocks had done well during the pandemic times. And guess what? They continue to do well. All of those stocks did very well after earnings. The only one that actually came down a little bit was Google. I guess you could say overall, Google, I would almost call it flat considering what really happened on that day. So the trade worked out in a sense that if you're buying protection on stocks that you own, you are still bullish, but you're nervous. You're nervous about something. So by buying the QQQs and having the stocks do very well, it allows you to not sell those stocks going into earnings. It allows you to try to be comfortable in your own skin as that big earnings announcement day and week happened, but the underlying stocks went up. So the question is then, if I did that type of trade, was I correct on my forecast or was I incorrect? Kind of like, what's the sound of one hand clapping? Ideally, I would have done better if the stocks went to the moon, and they all actually went up quite a bit. They had a pretty big move to the upside than I would have if the underlying would have went down, and I would have made money on my long put spreads or my long puts. But and a lot of times when people are buying insurance, they wrongly think of it as, oh, the stocks didn't go down, so I lost money by trading options. It's kind of like saying, Well, when I bought my car insurance, I didn't end up crashing it into a tree, so I lost money on my car insurance over that term, right? So I just kind of want to talk a little bit about that and address it, and then let's move on to another earnings trade that we're going to be looking at. Earnings season is still not over. The bulk of the companies have announced, but there are still a couple of companies, specifically in the pandemic times, that have done pretty well. We still have Home Depot, we have Lowe's. Etsy just announced today, if you want to include them in the online retailer space, and they did pretty well. Right now we're taping Options Playbook Radio, and it is Wednesday. The market is closed. It's August 5th, and Etsy has already announced that the market is up. So I actually have kind of came up with a trade around earnings and in this specific time. And if I were to write the Options Playbook one more time, I'd probably include this trade and use a term that is very prevalent nowadays in the texting world and TikTok and everything else that's going on in these times is FOMO, and that stands for fear of missing out. That's a little acronym. And I would actually like to title this the FOMO trade. How am I going to title this FOMO trade? Well, okay, we're going to use Walmart as an example because I think that is a stock that it's fairly relative about. Walmart today closed at $129.81. It's down $1.83. Walmart did set a high recently, an all-time high, actually, just a few days back. It ran all the way up to $134.13. The market right now is down about 6 points from then, right? $129.81 is where it's at. So we have a little bit of a down move. I guess it's more so like 5 points, but we've had a little bit of a down move since the high, and it didn't have as wild of a swing as a lot of the underlying stocks did during the pandemic. We did have a big move down in March, just like everybody else, but the stock battles its way back, actually came close to its high, came back down, went a little bit up. So it hasn't had the explosive growth that a lot of the stocks. The low in March before it started its upturn was at 102. Still having a very good, strong year, very good, strong growth since the lows in March overall. So how would we approach this? Let's say you're considering buying 100 shares of Walmart. The other stocks have done fairly well in the retail space. Walmart is doing a little bit better on the online space. Now, once again, not meant to be a recommendation, and this trade is really meant to be a FOMO trade. In other words, that you need to be a cherry picker in this type of marketplace. But a lot of these stocks that have done well have done exceedingly well, and their stock price has gone along with it. Home Depot is a great example of that. That stock has really just thrived during these times. I guess home projects are big when you're staying at home and working from home. So let's look at Walmart. Walmart's going to be announcing earnings. The only reason why I picked them is because they're going to be announcing earnings within the next couple of weeks. And it's also one of the winners in this pandemic. As far as the company is concerned, they're doing fairly well. So August 18th is when they're going to be announcing earnings. And the way that I would approach my FOMO trade, fear of missing out, because there is not a name for this strategy, what we're going to look to do is sell a put, saying that if the market came down, I'm going to take the approach that I'm willing to buy some shares of Walmart if the market actually goes down after earnings. And then that kind of makes me a little nervous because what if they do really well on earnings? So how am I going to protect myself against an upward movement in the marketplace in case there are really good earnings and that stock sets an all-time high after they announce earnings? So the way that I'm going to approach this is I'm going to actually sell a put, a cash secured put, which I might do anyways if I just wanted to buy Walmart, go out and sell a cash secured put saying that it's a $129 stock. We sell the 124 strike. So that means that I'm willing to spend $12,400 to buy 100 shares of Walmart. And don't forget, I got to add commissions into that. And if I'm willing to do that, I put the cash up. You can do this in a retirement account if you have that level of approval in most brokerage firms in their retirement account, saying that if the stock does come down to that strike, I'd be willing to buy it. And when I sell a put, I'm saying I will take on that obligation to buy the underlying at that strike if at expiration that underlying stock is below that strike price. Now, by doing the expiration that is after the earnings announcement, you're going to get a little bit of juice for that. So we're looking at the August 21st expiration. The 124 strike put with Walmart at 129.81 is trading for $1.54 on the bid and $1.63 on the ask. Now the markets are closed, so let's say we could get $1.60 for that. That's getting a decent amount of premium on Walmart. Just saying that I would be willing to buy it if the stock went down. Now, let's address the other side, though. What if the stock goes up? We just saw it happen in Apple. We just saw it happen in Facebook. We just saw it happen in Amazon. All those stocks went up after earnings. So I'm a little bit nervous that, well, if I do this, I wouldn't mind buying it at a lower price. But what if the stock just takes off and then I'm just going to, the maximum that I could make on that trade would be that premium that I received from selling that put option. And then I would have to buy it at what could be a much higher price. So how can I offset that? Well, one way to look at it is I'm going to take that credit from selling that put and saying, okay, to the upside, I'm going to buy a long call spread. Now, why am I doing a spread? Well, once again, it's earnings. So the prices of the option contracts are a little, quote unquote, inflated, but it's because of the known event. So we have implied volatility is a little higher than they normally will be. And I'm going to use the same expiration and I'm going to buy the 130 strike call and sell the 134 strike call. So that's a 4-point wide spread. And guess what that spread's trading for? About 160. So I can do this entire trade right now. If I put this all into the Ally Invest option chains and look at the workbench, this can actually be done for a net credit of about 3 cents to the account. Let's just call it even. In other words, I'm putting this trade on and I'm saying, well, this entire gaggle of securities is a fear of missing out going into earnings on Walmart. I think Walmart may come down a little bit. We just hit an all-time high. It's kind of came down a little bit since it's hit its all-time high. It didn't proceed and basically take off after hitting that level. And now we have earnings. So would I like to buy a little bit if it came down? My concept here is that I wouldn't mind buying it at a little bit lower price after earnings. But then again, earnings makes me nervous. So what do? I sell the put saying I'm willing to buy it a little bit lower. And then I go out and I buy a long call spread just in case the underlying stock moves up. Now, if I look at earnings and I just look flat out at what the expected move is, we're a little bit away. And we're just doing this on paper. It's not meant to be a recommendation, as always, here on Options Playbook Radio. We're just talking about the FOMO trade, if I can coin it that way, around earnings on different companies that you might be interested in looking at. And Walmart just happens to be in that world. So, if we're doing this trade, we'd probably do it a little bit closer to the earnings report, considering that it is on the 18th and today is the 5th. But with that being said, if I look at the that expiration 16 days away, and I look at that long straddle on Walmart, we're talking about $7.70. So that's the type of move that you might see. So these ranges on these strike prices that we're using, the market is saying that it's very feasible for this to happen, and that this underlying stock 124 with the stock basically trading, we'll call it 130, that's going to be 7 points below the market. And then on the upside 134, that's only 4 points above the market. So it's very possible for this underlying to go above that range. And we're just talking about selling one contract here. So we're pretending in our paper trading world that we wouldn't mind buying 100 shares of Walmart at a lower price. And we're going to protect ourselves in case earnings are good and the stock actually moves hard to the upside. Now, if I do sell this put, I could do it and try to get a small net credit to the account so that if the stock just kind of stays where it's at, well, at least I get rewarded for my process. And a way that I could do that is just go a little bit more out of the money. Instead of buying the 132 strike or 130 strike, maybe I buy the 132 strike and then I sell the 136, and that makes it a little bit cheaper, a little bit more speculative on the upside. I still just want to make sure that it's within the range of what the expected move is, and that would be. So I could do the 132 and I could sell the 136. That would mean that that's within that 7-point range. The market thinks that it may be able to move that based off of the long straddle, if you will. So this is just a fear of missing out. I have an underlying stock that's going into earnings. It's been a little frothy because of the current times that we are in. I wouldn't mind buying some if after earnings it came down. But then again, I'm also worried that after earnings it might go up. So I want to protect myself on both ways. This is one way to do it. I'm going to sell a put to pay for a long call spread. So let's do a quick review of the trade. Today we are taping Options Playbook Radio. It is August 5th. The markets are closed. We are going to go out to the August 21st expiration. Why? Because Walmart is going to announce earnings. Right now, the anticipated date is the 18th of August before the open. We are going to sell that August 21st 124 strike put, and then use those proceeds to buy the August 21st 130 strike call, and then sell the August 21st 134 strike call. We're going to do this for a 0 credit or debit to the account. That means that most people, if I'm entering all three of these as one trade, I would enter this as even on your trade ticket, saying I'm not going to receive a credit or a debit. I'm still going to have to pay commissions for that trade. So if I do this trade, I want to have the capability to buy 100 shares of Walmart. If the stock goes down to 124, that would be $12,400 to buy 100 shares at that price of 124. And on the upside, I'm going to have 4 points of upside. I didn't pay for this trade. In theory, right, if we do it for 0, we just have to pay commissions. If there are commissions on this underlying, or if there are commissions on this trade, you would have to pay those, and that would obviously be a cost to you. But from 130 to 134, that would be our best case scenario. If the stock goes above 134, then we can make $4 on this trade. We didn't pay anything for the trade, so that would be $400 times 1, or 100 shares for every 1 by 1 by 1 FOMO trade that we put on. And once again, this trade strategy does not have a name. We don't have it inside the options playbook, but it's a very common strategy, very similar to when we actually named the fig leaf or a leverage covered call, where you buy a deep in the money put and sell a near-term call against it. That was a trade that was very popular overall, but nobody ever came up for a name for it. So this is just an interesting trade in these times when we have some stocks that are doing well and some stocks that are doing really bad. We have earnings coming up, a FOMO trade where I sell a put to pay for a long call spread. And I guess that's going to be it for this edition of Options Playbook Radio. If you have a question you'd like us to address on the show, please email me at theoptionsguy@invest.ally.com. And please follow me on Twitter. My handle is Brian Overby. And until the next time, may all the options that you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.